How you doing, family? Welcome back for another edition of the Wealthy Wallet Wall Street course. We're gonna go ahead and jump right into it. Section two: knowledge is the beginning of power. And I call this the knowledge of beginning of power is because the more that you know, the more you'll be able to control events. I said the more that you know, the more you are able to control events. The more you are able to predict the outcome. They gave you a driver's license because you have the knowledge of how to drive. They give you a nursing license or a law license because you have the knowledge of how those things work. And the more you and because you have the knowledge of how those things work, the more they will pay you. Knowledge is it's an awareness. It's an understanding of how something or someone works. It's an understanding of how something operates, of how someone operates. But the less you know about something, the more it could potentially hurt you. The reason you're not the CEO of the company is because you don't know how to operate that company. The more knowledge you get on how to operate the company which you are in, the higher level that you get into, that promote you. Why? Because your knowledge has increased your value. Therefore, they can pay you more because you know more. See, but a lot of people expect to get paid more when they don't know more, and they get mad when they ask when their boss or something or someone asks them to do more so that they can learn more. But they get mad about that because they feel like, oh, I'm not getting paid for it. But in order to get paid to the next level, then you have to begin to know more and be able to experience more things. Knowledge is the beginning of power. And that's because the more you know, the more valuable you become. Value is in your knowledge, value is in what you know. The more information that you take in, the more information that you know. If you will have a CDL's license, and I'm using that as an example, you will have a CDL license if you knew how to drive big rigs, right? If you knew how to drive big trucks, they give you a CDL license. But because you don't have that knowledge of how to drive big rig trucks, then you don't get a CDL license to make 60 or 70 grand a year. And it's like software developers. They pay them because they know how to write code. They're willing to pay them $100,000 a year because of what they know. So the more you know, the more valuable you become. The more you know, the more you can lift your life up. The more you know, the more power you gain because knowledge is being able to control events. It's been aware, or should I say, it's been able to understand or know how something works. When you know how something works, then of course you can control the event. When you know how something works, if you knew every question, every answer to the question on a test, then you will be able to pass that test with flying colors. So you don't have to be stressed out and worry if you're going to be able to pass the test or not. Why? Because you control the event. Because why do you control the event? Because you know all the answers. See, it's all about knowing how something works. If you knew how the algorithm on Instagram works, then you can easily grow your following because you know how the algorithm works. If you knew how the algorithm works on TikTok or YouTube or any other social media channel, the more knowledge that you have on how that works, the greater influence that you can produce. But it all depends on your knowledge of it. That's why everything you do in life, you should always seek to gain a complete understanding of how it works. Because understanding of how something works will give you such great confidence because you know that you're going to be able to control the event because you understand how things work. So the more that you understand how things work, the more money you're going to make. The more you know, the better chance you have of controlling the outcome. So the goal is to know. You got to know. So let's start by knowing. And I want to teach you how to make money, but you first got to know how to make money. You got to know how to invest. You got to know when to invest. You got to know when stocks are on the move. And that's the biggest thing with the stock market. Knowledge is everything in the stock market. Knowledge is everything on Wall Street. Because if you don't know something about a company and that company could be on the brinks of bankruptcy and you invest into a company, all your money gone. You know why? Because you didn't have the knowledge. Knowledge is everything. If you don't know the debt the company's in, if you don't know what type of product they're producing, you just jumping into a company and you don't know anything about it, then you're asking for them to take your money. You're asking for Wall Street to take your money because you're jumping in with no knowledge or no understanding of how something works or how a company works. This works all through life and everything. If you knew exactly that those failed relationships that you got in, if you knew exactly the who you were getting yourself involved with, then you probably would have said, I'm gonna save myself that trouble. But because you didn't have the knowledge of that, it cost you a lot of drama. So then, therefore, knowledge again is the beginning of power. You got to know. And on Wall Street, knowledge is everything. And that's why we got to start learning how Wall Street operates. And if we learn how Wall Street operates, then we can start making money and not just jumping into something and immediately losing money. And then we get this icky feeling of failure, and then we quit and give up, and we never go back into it when we miss the opportunity to make hundreds of thousands of dollars. But because we jumped in not knowing and we lost money because we didn't have the knowledge, then we miss out on the opportunity of what could have been. So you have to get the knowledge. Knowledge is the beginning of power. When operating on Wall Street, you have to understand that there are two basic approaches to investing in the stock market. There are fundamental and technical investing. Fundamental and technical investing are two major ways of learning how to invest when it comes to approaching the markets. Yet they are at opposite ends of the spectrum. Investors and traders use both to research and forecast future stock prices. Like any investment strategy or philosophy, both have advocates and adversaries. So let's dig into what is fundamental investing. Fundamental investing evaluates stocks by attempting to measure their intrinsic value. And fundamental investor studies everything from the overall economy and the industry conditions to the financial strength and management of individual companies. They study their earnings, their expenses, their assets, and liabilities, all come under scrutiny by fundamental investors. So the main goal of a fundamental investor is to understand the cash flow of the company. Is the company making money? Is the industry that the company in, is that going to be a big part of the future? How's the economy doing right now? They look at it from a bird's eye view. They want to know the company's intrinsic value. Does the company have any real true value? Or is the company not making any money at all? They don't have any future value whatsoever. No, when you're a fundamental investor, you need to know every single number. You look at the financial statement. We're going to talk about the financial statement in a later course. But the financial statement is everything to a fundamental investor. And also the shape of the economy and also the industry that that company's in. Fundamental investing is knowing the numbers. You got to know the numbers when you're a fundamental investor, because those numbers determine if the company has intrinsic value or not. It determines if a company has intrinsic value or not. Okay, then, so what is intrinsic value? Intrinsic value is a measure of what an asset is worth. So if I don't take a look at all the numbers, if I don't take a look at the product they're producing, how much money they're making off their product, how much debt they got, how much money they're projected to make into the future, if I don't know all these things, then I cannot predict what an asset is literally worth. I can't predict what this company is going to be worth in 5 years if I don't have the numbers. That's why it's very imperative to look up, to be able to read a financial statement so that you can be able to fundamentally determine a company's value. And all their value is a measure of what you think the company is going to be worth in the near future or even in the far future, depending on if you're a longer term investor. You want to know that this company is going to continue to make superb products and they're going to continue to increase their margin of profit, right? So you got to know these things in order to measure a company's intrinsic value. But let's go back. And we measure all these things. So that we can analyze a company so that we have the knowledge. There that word goes again, so that we have the know-how to invest. Because if I have a knowledge that, man, this company is not going to do anything but continue to grow, then I know that when I invest in it, my money's going to grow. But if I don't have the knowledge that this company is literally not making any good products, they haven't made any good products for 10 years, their profit margins are getting shorter and shorter, their debt is growing bigger and bigger, then I know that it's only a matter of time before this company goes out of business. So why would I put my money there? See, but if I didn't take a look at the financial statement and take a look at what the company was doing, then when I put my money in there, I should lose it all. Why? Because I didn't take the time to get the knowledge of what the company assets look like or what the company intrinsic value was. That's why it's very important to understand a company based upon its value. And most investors do that. Even if you're a technical investor, they still do some sort of fundamental investing because they want to understand that the company that they're investing in is not going to file bankruptcy tomorrow, right? Or the company they're investing in is at least going to grow, because if the company doesn't grow, then their investment is not going to grow. So, in a nutshell, fundamental investing is understanding the company's intrinsic value according to the economy and the industry that it's in, right? And then that puts us to the next, technical investing. What is technical investing? Technical investing differs from fundamental analysis. They attempt to identify opportunities by looking at statistical trends, such as movement in a stock price and value. The core assumption is that all known fundamentals are factored into price. Thus, there is no need to pay close attention to them. Technical investing do not attempt to measure or securities interest intrinsic value. Instead, they use stock charts to identify patterns and trends that suggest what a stock will do in the future. So the difference between fundamental investing and technical investing really don't use intrinsic value as a guide to invest. They use charts per se and look for patterns in charts to invest. They say, okay, oh, this pattern shows that every 5 days that this stock moves up 3 to 4 cents. 3 to 4% or 5 to 10%. And then every 3 days after it moves up 5 to 10%, it goes back down 5 or 10%. So they're using charts and patterns to understand the movement of the stock and the trajectory that the stock or the trend that the stock is on. They're looking at charts to determine when to jump in and when to jump out. Where our fundamental investors mostly are long-term investors, technical investors are short-term investors or near-term investors. Reason being is because they're looking at charts based on a short amount of data to determine whether they should jump in or to determine when they should jump in and jump out to make money in the short term or near term. But fundamental investors think of them as long-term investors because they're looking for a company's growth. But like I said, even technical investors also somewhat do a little fundamental investing. They still want to know the company's not going to file bankruptcy tomorrow. So they do know the product. They do know the company they're investing in. They might not take a look at the financial sheets, that might not matter to them as much, but technical investors do have somewhat of a knowledge of how the company's doing. But they usually work off charts. They usually look at patterns and how a certain pattern will help them to make money. So technical investing, look at it as pattern trading. Fundamental investing is intrinsic value trading. So when you invest into a company based on fundamentals, you invest into a company based upon its intrinsic value. When you invest in a company based on technical analysis, you are investing in a company based upon its pattern. It's chart patterns. You're basing upon chart patterns, right? So that's the clear understanding of that. Next, we move on to when and where. So now that you understand what fundamental investing is and you understand what technical investing is, then when should you jump into a stock and where should you get out at? See, this is where it all comes together. Now we're about to go into studying charts because you got to know when to get in and where to get out. You got to know where the exit is and when it's time to exit. The where and the when is everything in the stock market. Because if you know when to get in and then when to jump out, you make gains or you stop from losing money. So let's go into what I call the candlesticks control the story. We're going to start off this by starting from a technical analysis point by learning candlesticks. The reason why I want to start from a technical analysis point is because I want you to understand that the candlesticks control the story. They control the story. They tell you whether the story is going to be good. They tell you whether the story is going to be bad. They tell you how the story is going to go. They're going to tell you how the story is going to go in the middle, beginning, and end. The candlesticks control the narrative. They control the story. They control what happens. They control the plot. The candlesticks control everything. And therefore, if the candlesticks control everything, it's very imperative that we learn about candlesticks, right? So we start off with technical analysis when we're jumping into the stock market because some people don't like to wait long term. Some people are not in their term investors. Some people want to get in there and make their money in a few days, make their money in less than a month, and they want to punch out. So we're going to start with technical investing. So technical investing starts with understanding the story. And the only way to understand the story is to understand the candlesticks because the candlesticks control the narrative. So if the candlestick control the narrative, let's dig into candlesticks. You see here, right here, I have the high. This is a candlestick, a green candlestick. This is what a green candlestick was. A green candlestick opens here and it closes here. And why do we have this bull right here? It's because bulls thrust their horns in the air, meaning an uptrend. Remember, we learned in the previous course, in the previous class, I mean, that if something is bullish, then it means it's on an uptrend. You have a bull market, you have a bear market, right? We learned that in the previous class. So if you have a candlestick, a green candlestick is a bullish candlestick, right? And the green candlestick always opens at the bottom and closes at the top. So if it's green, we're entering into a bull market. If you got constantly green sticks and constantly green sticks are climbing up, right? The stock is trending upwards, right? But I want you to understand how a green candle works first. This is the body. This is the wick. We're going to go more in detail about this though, but this is the body of a candlestick. This is the wick of a candlestick. And this is the wick of a candlestick. So that means the stock opened here, right? And it pushed down here just a little bit. And then it pushed itself back all the way here. And then it closed right here. That's what happened. This is what this candlestick told you. It told you it opened right here. And then the sellers came, pushed it down. And the buyer said, no, buddy. We need this to stay green. So then it went up. And it went up some more. And then the seller said, no, man, hold on for a second. Y'all doing too much. So the sellers pushed it down here and it closed right here, right? And then you have the bear candlestick, right? Bear swipe their paws downward. So we understand if they swipe their paws downward, the price is on a decline. So a red candlestick, it opens here, right? And it closes here. So it's in reverse. Green opens here, closes here. Red opens here, closes here. Again, this is the body of a candlestick. This is the wick. Oh, I'm sorry. This is the wick. So if it opened here, and it says, the buyer said, I want to push this up, but the seller said, no, I need this candlestick to go down. right now I don't like the way it's trending, so I'm punching out, right? So they punching out. So when money goes out of a stock, it goes down. The more money comes into stock, it makes the stock go up. So, but money is going out of the stock because it's turning red. So they selling their shares. People over here buying shares. People over here selling shares. That's why it opened here, and people bought more and more and more, and it went up. And then they said, and then people started to sell off, and then it went sell, 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 and then the buyers gained back a little control. Then it closed here. So a fully formed candle represents the duration time that corresponds with the theme of the charts. For example, a fully formed candle in 5 minute charts represents 5 minutes. So, so let's say this is a 5 minute candlestick. It could be a 10 minute candlestick. It could be a 1 hour candlestick. It depends on how you got your chart set up, or whatever chart you're looking at, or whatever brokerage you are going through trading, how they have the chart set up. Most of them have it set up on 5 minutes, right? So if this is a 5 minute chart, then I know this 5 minute chart. In 5 minutes, the buyers took control. And in 5 minutes over here, the sellers took control, because this is a red candle. This is a green candle. So when it's green, I know the bulls had control the whole time. When it's red, I know the bears had control the whole time. So you got to understand who's in control. Remember, the candlesticks control the narrative. So here's a candlestick chart. This is a little more in depth for you. So upper shadow, right? This is an upper shadow, right? We talked about the wick. It opened here, green candle opens here, and it closes here. But then but then its high is up here, and then it's very low. So it came all the way down here, and it came all the way here. Even though it opened here, pushed down all the way up here, and then the buyers took over control again and pushed it all the way to here. And then the sellers came back and took control, and it ended up right here, right? Same thing over here. But it said the bears took control of this candle. The bulls took control of this candle, and then the bears took control of this candle. So it opened here, right? Closed here. It opened here, closed here. But as it opened, the buyers said, no, we need this thing to go up. So it pushed it all the way up here. And the sellers said, no, I need this thing to be sold off. And it pushed all the way down here. And the buyers took control again. And they got it right here. But ultimately, the sellers won. Ultimately, they won. They won the match. So therefore, it's a red candlestick instead of a green one, because the sailors won and not the buyers. The bears won and not the bulls, right? So let's move on. This is going over more of the where, how, and when to jump in, right?